SVB's collapse wasn't about risky startups. It was about a bank that ignored warnings about its own bond portfolio for over a year. $209 billion in assets, a loan book that was performing well, and a collapse that took 48 hours. The story most people heard blamed Silicon Valley's startup culture, the risky bets, the burn rates, the companies that never made money. That story is wrong. Welcome to Know Tech, and this is the real story of what broke Silicon Valley Bank. When SVB failed on March 10, 2023, the instinct was immediate. A bank for startups collapsed. Obviously, the startups were the problem. It's an understandable conclusion. Silicon Valley Bank had spent 40 years building its identity around the startup ecosystem. It banked venture capital firms. It banked the companies those firms funded. It was, by design, woven into the fabric of tech. So when it fell, the false narrative wrote itself. Silicon Valley had finally overextended. The bubble had popped. The reckless lending had caught up. I believed a version of this too, at first. It felt coherent. It fit the pattern. But when I started looking at the actual numbers, something didn't add up. SVB's loan book wasn't collapsing. The loans were being repaid. The crisis wasn't coming from the startups at all. It was coming from somewhere the public narrative barely mentioned. So what actually broke SVB? To find out, we need to understand what the bank was actually holding and why those holdings became a trap. To understand what actually happened, you need to understand one concept: duration mismatch. Banks take in deposits, short-term money that customers can withdraw anytime. They invest that money in assets that earn a return. Normally, they try to match the time horizon of those assets to the time horizon of the deposits. SVB did not do that. By late 2021 and into 2022, SVB had accumulated roughly $91 billion in long-term securities, mortgage-backed securities and treasuries, with maturities stretching years into the future. This was a calculated bet. In a low-rate environment, long-term bonds pay more. SVB was chasing yield. But in March 2022, the Federal Reserve began raising interest rates. And then it kept raising them. 25 basis points, 50, 75, again and again. By March 2023, the Fed had raised rates by 425 basis points in 12 months, the fastest tightening cycle in 4 decades. Here's the mechanism. When interest rates rise, the market value of existing long-term bonds falls, not because the bonds are bad, but because newer bonds now offer higher yields, making the older ones less attractive to buyers. SVB's $91 billion portfolio was quietly losing market value with every rate hike. The losses weren't realized yet. They existed only on paper, in the held to maturity and available for sale categories of SVB's balance sheet. The bonds hadn't defaulted. They would eventually pay back full face value at maturity. But SVB might need to sell them before maturity, and if it did, it would sell them at a loss. According to post-mortem analyses and regulatory reviews, internal stress tests had flagged this risk. Scenarios modeling a significant rate increase projected losses that could exceed $10 billion, an approximate figure, but one that reportedly reached senior leadership. The mismatch was documented, the risk was known, and yet the portfolio was not restructured. Duration mismatch alone doesn't collapse a bank overnight. What turns a slow-burning problem into a 48-hour catastrophe is who your depositors are. At most U.S. banks, somewhere between 40 and 60% of deposits exceed the FDIC insurance limit of $250,000. At SVB, the figure was somewhere between 93 and 97%. Almost every dollar deposited at SVB was above the insurance threshold. That matters enormously. When a depositor with $250,000 hears bad news about their bank, they might panic. But they're insured. Their money is safe no matter what happens. When a depositor with $50 million hears bad news, they have every rational incentive to move immediately. Their money is not protected above the limit. Waiting could mean losing tens of millions of dollars. And here's what made SVB uniquely fragile. Its depositors weren't just large, they were correlated. These weren't strangers scattered across the country, they were colleagues. They sat on the same boards, they shared the same investors, they read the same newsletters and monitored the same group chats. When one large depositor decided to move, the information spread instantly through a network that was already primed to act together. That's not a coincidence. It's a structural feature of a bank that had, by design, concentrated itself inside a single ecosystem. A concentrated, correlated depositor base doesn't just make a bank run more likely, it makes it faster and more total. This concentration risk was visible in SVB's public filings. Any analyst reading the annual reports could see it. Regulatory frameworks, however, did not adequately penalize it, and so it persisted year after year, growing more dangerous as the deposit base grew. SVB had built a business model that was extraordinarily efficient at serving one sector, and extraordinarily vulnerable if that sector moved together. On March 8, 2023, SVB announced it had sold a portion of its available-for-sale securities at a realized loss of $1.8 billion. The bank said it needed to raise capital to offset the loss. The announcement was meant to reassure investors. It did the opposite. For SVB's depositors, the announcement confirmed what many had been quietly worrying about. The bond portfolio had real losses. The bank needed cash, and anyone with uninsured deposits had a rational reason to leave immediately. What followed was approximately $42 billion in deposit withdrawals over roughly 48 hours, from March 8th through March 10th. To put that in context, SVB's total deposit base was roughly $173 billion. In 48 hours, it lost roughly a quarter of that. Not because the loans were bad, not because the assets had vanished, but because the confidence had. That withdrawal speed exceeded historical bank-run precedents. Whether social media directly caused the coordination or simply amplified an already rational response from a concentrated depositor base remains analytically debated, but the result was undeniable. On March 10th, the California Department of Financial Protection and Innovation closed Silicon Valley Bank and appointed the FDIC as receiver. 2 days later, on March 12th, the Treasury Department, the Federal Reserve, and the FDIC issued a joint statement. All depositors, including those above the insurance limit, would be made whole. No startup lost its deposits. No VC fund lost its capital. The crisis was real. The losses to depositors were ultimately prevented. But the bank was gone. Here's what makes this story more than a financial footnote. The risk wasn't invisible. According to post-mortem analyses and the Federal Reserve's own supervisory review released in April 2023, SVB's internal risk functions had reportedly flagged the duration mismatch. Stress tests had modeled scenarios where rising rates would cause losses that could exceed $10 billion. The Federal Reserve's review also noted that SVB had been cited for deficiencies in its risk management practices, and that supervisory warnings had not produced adequate responses from management. And yet, the portfolio was not restructured. The duration mismatch persisted through 12 months of rate hikes, each one a step closer to the edge. Why? Restructuring the portfolio would have meant selling bonds at a loss, realizing those losses on paper in the financial statements for everyone to see. It would have meant admitting publicly that the yield-chasing strategy of 2020 and 2021 had become a liability. The bank appears to have chosen to hold, to keep the losses unrealized, to hope that rates would fall before a forced sale became necessary. That's not an unusual calculation. Banks make it all the time, but it's a fragile one. It assumes you'll never need the cash before the bonds mature. And it assumes your depositors will give you the time to wait. SVB's depositor base made that assumption catastrophically wrong. The moment the bank needed to sell, the concentrated depositors ensured it had to sell everything, and fast. SVB's failure wasn't a black swan. It wasn't unforeseeable. It was the intersection of a known risk, a governance failure to act on that risk, and a depositor structure that left no margin for error. The false narrative that SVB's collapse proved startup lending is inherently dangerous is not just wrong, it's a distraction. It directs attention away from the questions that actually matter. How did a sophisticated institution, with documented warnings and regulatory citations, fail to act on a known risk for 12 months? How did frameworks designed to protect depositors miss a concentration risk that was sitting in public filings? And what does it mean when a single bank becomes the financial backbone of an entire industry? SVB's story is a reminder that financial fragility doesn't always announce itself with bad loans or reckless speculation. Sometimes it hides in the gap between what a portfolio is worth today and what it will be worth if you have to sell it tomorrow. SVB reminds us that the most dangerous risks aren't the ones nobody sees. They're the ones everyone sees, and nobody acts on. But SVB isn't the only institution where a duration mismatch sat quietly on a balance sheet while supervisors and executives weighed the cost of acting against the cost of waiting. I'm here to help you know the risks hiding in plain sight. Which startup bank's balance sheet should we put under the microscope next? And what duration mismatch are we not talking about? Drop your answer in the comments. See you at the next filing.